Welcome to the daily update, where I'll go over the action in the market from Monday, September 23rd, and then we'll see how things look for Tuesday, September 24th. Not an awful lot has really changed in the scenario. We're positive, and we're seeing a bit of an improvement with the smart money indicators that we follow, and I'll show you those charts. But we still have this confirmed Hindenburg omen in the background, which may lead to something, but it can take a little bit of time for that to actually kick in, and that's quite a negative signal. And we also have negative seasonality that doesn't necessarily seem to be appearing, at least yet. It was a pretty slow day on Monday, not an awful lot of conviction. Maybe you have both sides just kind of staring at each other, the buyers and the sellers, saying, okay, what's going to win out here? The battle was not really decided all that much. So we ended up having an up day. It improved some of our indicators. We're still looking good in the short, intermediate, and long term, but we want to just respect these things that are in the background. There's the SPXInvesting Program that you're more than welcome to check out. It's currently free. I will be locking that down at some point, and I post additional videos there. There's courses that I have there that I will be rolling out. And if you want to find out more about the program itself, there's a link that will take you to the video. There's also a link that will take you to the website. If you have any questions, you can email me, and you also get early access to the daily videos and the weekly videos. The daily video is the real foundation of what I do. The weekly videos and all of the different ones that I do there are meant to tie into the daily video. Okay, let's go back and talk about what happened. We did have a higher open. There wasn't a gap. We just kind of moved higher right after the market opened. And we got up to R1 at 57.20. Then we declined back down to the unchanged level. And then we closed or rose back up to R1 to close at R1. So it really wasn't all that eventful. We were up 0.28% on below average volume. We're back to that. So there's some kind of wait and see mode currently going on. And we are positive in the short, intermediate, and long term. Our short-term indicators are suggesting either good momentum or that we're getting a little toppy right now. We did set a new intraday all-time high with the S&P, and the Dow set an all-time closing high. And that's typically a good thing unless it's some kind of a blow off top, but we're not necessarily seeing that yet because inflation seems to be under control, and interest rates, even though they're inching back up, are much lower than they were, and the market feels that this is a more interest rate friendly environment. But we want to be aware of all the different geopolitical things that are happening. But for the time being, this doesn't seem to have much of an impact, if any, on the market right now. The Dow and the S&P did set new all-time highs again, and we're wondering about FOMO. Now, it didn't seem to be that big of a deal on Monday, but there were probably people that came in over the weekend and said, okay, the Fed cut rates. The market's looking pretty good right now. I'm afraid that I'm going to miss out on any future gains, so I need to get in right now. And that's the fear of missing out. Doesn't seem to be a real frenzy, at least in Monday's session. We do have a confirmed Hindenburg omen that was triggered on the 12th of September. And we also have weak seasonality that's in the background, but it doesn't seem to have kicked in, at least yet. On a short-term basis, we have the 20-period exponential moving average, the Stochh RSI, Williams percent R, CCI 14 and 20, and the stochastics. Those are the usual indicators on a short-term basis that start to get extreme when we move, which again, you can say good momentum or looking overextended. The boom 20, we're still kind of far away from that 20-period moving average. That's not necessarily on the list all that often, where these other indicators quite often are. In the intermediate term, we still have the CMB composite, the 50-period exponential moving average. The Erin indicator is actually coming down, but I have it on this list because it's kind of acting strange right now. The Sean trend meter, the bullish percent index for the S&P, and then a longer term, intermediate term indicator, which is the 10-period new highs and new lows for the S&P. And we're still looking either good from a momentum standpoint or overextended with our 150 and 200 period moving averages. This is the scenario that was pretty much in place after last week, that yes, the Fed did come in and cut rates 0.5%, because right now it looks like a soft landing, meaning that we will not go into a recession, seems possible. The dollar was up and interest rates are up just barely. We're kind of ticking around that 3.74 to 3.73 area. It's how you round it up or you round it down. So I have it unchanged here, but it really ticked up a little bit in Monday's session. And we're still inverted with the 10 to the 3-month yield curve, where we're uninverted with the 10 to the 2 yield curve. Sentiment ticked up a notch to 64. We're still positive. It's when we get up to 75, that's when we start to use this as a contrarian type of indicator. And we are trending now, and we're just barely below the 20 level with the ADX. Now, in the short term ADX has crossed above 20. So the short-term trend is now confirmed. What I focus on more is the intermediate term trend, and it's just a little bit below that 20 level. With the up day, our bias is positive and our momentum is positive. We did get 2 reports, but I'm not going to show the charts here. The takeaway from this is, are these readings above or below 50? The global manufacturing PMI came in at 47. That's below 50. That's showing a contraction. The services PMI came in at 55.4. That's showing expansion. And so I don't show the charts there. And it says so far in 2024, we've set 39 new highs for the S&P. So we just keep setting new high after new high. Not a record, but still, it's not suggesting a blow off top where we just go up, set a high, and then turn and go down from there. Looking at the buybacks, haven't talked about those in the last week or so. Still looking very healthy as companies are coming in and buying their own stock. That helps push up the price, and that means, oh, there's confidence in this company because they're willing to take their own money and buy their own stock. Looking at the equity fund flows, we're starting to see some money coming back in now as the market has been going higher. And I won't go through all of this. This just shows where the money is coming into the market, and the red areas are where the money is coming out of the market. And low volatility, these are more defensive type stocks. We're seeing some money coming out of that. That could switch us back potentially into more of a growth phase, but we're not seeing any of that in our charts right now. And then rate cuts by meeting. This is just more historical, just what they've done. There's been some things over the last few days since the Fed cut rate 50 basis points. They say, okay, well, when's the last time the Fed cut by 50 basis points? Well, it was after 9/11. Actually, they cut it a full percent while the market was closed. It was 2008. It was the COVID, all that stuff that went on. Yeah, though that's true. But there are other times when the Fed came in and cut rates 50 basis points and the market was doing just fine. So we have to know the context. We can't just always look at a chart and say, because it happened that way before, it's going to happen again. We want to know what's going on behind that chart as well, even though the charts are what we use to determine, okay, are we seeing weakness or strength coming into the market right now? Then systematic strategies and their positioning. This is where you follow a system, where you just say, okay, I get into an S&P 500 index type fund and I just follow that. And when the indexes are going up, we're seeing money coming back into that type of a system. The opposite of this would be discretionary, where you can move things around, you can maneuver, you can get out of the market for a while. This is more of just, okay, I'm sticking to a set system no matter what's happening in the market. Mega cap growth and tech positioning coming down a little bit, is we're not seeing that be the real darling area right now. Still doing well, still up strong on the year, but not getting all the attention as far as investing is concerned, at least lately. And then this rarely happens. The Fed is cutting into an earnings per share recovery. When over the weekend in the weekly video, I usually show a chart that just shows the earnings per share projections going out into the future. They keep going up. It's a red arrow pointing up and to the right. That's earnings per share looking better. And we're now having rates coming down. And this is just a historical chart just to show, okay, there are times when the Fed cuts rates, even though earnings are looking a little bit better. That's the context that we're dealing with. That's the soft landing. And until we have something that happens to change that scenario, that's what the market is currently going with. I didn't spend any time on Twitter. I'm traveling right now and trying to spend every available minute doing touristy type things. So it was a pretty quiet day, all in all. We did have a higher open, not much of a gap, but we went up to R1, came back down almost to the unchanged level, went back up to R1, and that's just about where we closed. The intraday chart, not much of a change in the initial overnight session here. The futures were doing okay. They actually were down a little bit, and we were able to work our way back to the unchanged level by the time we opened. This is also a little bit of a concern. We still see the red line above the blue line here. That means value is outperforming growth intraday. We want the blue line to be on top. And we're just kind of going flat to sideways now with our intraday chart of S&P growth to value. We would like to see that go up. End of day chart. Growth was up, but up less than value for the large caps, up more for the mid caps. It was up for the small caps, where value was down for the small caps. So again, we're not really seeing any big turn here with small cap growth to value. We actually declined a little bit with mid cap growth to value and still not looking very solid. And holding up okay, but not really seeing any breakout now with S&P growth to value. We want this line to go up if we're more positive. We're still inside the rainbow when we compare the growth to value ETF. And discretionary showing some improvement here when we compare it to staples, but we still want to see more follow through with this. Large cap growth is still holding up. It was up 0.18% above all the moving averages. And in the intermediate term, we're above the moving average. It's really hard to see because they're almost on top of each other, but the green line's on top. So we have a trend, but we're still below 20, but it's a positive trend since the green line's on top. Now we're starting to cross above 20 with the short-term ADX, and we're above the moving average. So the short-term trend is confirmed, and it's positive since the green line is above the red line. And we really dropped off with volume. We were below average after that monster volume day we saw last Friday for triple or quadruple witching. Looking at this sentiment gauge, we are looking extreme right now. We're not seeing that in our readings, but that's what they're showing here. This is the legal insider transaction ratio coming back down, actually turning a little bit more bullish after it had been getting up into this area that tends to be more bearish. And then when I show that chart, I show this chart here, which is the insider buying ETF. Really kind of going sideways, more or less, right now. We did decline with the VIX with the line chart as well as the bar chart as fear is dropping off. We're also going down with the VIX of the VIX to measure the volatility of the VIX. We're still going down with the VIX as measured by the MACD to show the downward momentum. But this is a historical chart, and this is what we're wondering is going to happen as we work our way through the end of September and into October. We're still getting a very high reading with the skew index. It came down, but we're still way up into this red area that the market is still anticipating some kind of a move. Is it going to be a move up or down? Our charts say we're still looking positive, but seasonality in this Hindenburg-Omen suggests it could be to the downside. And we ticked up just a little bit with this fear gauge, and we ticked down with this other fear gauge. So not a lot of confirmation there. We declined with the daily chart of the equity put call ratio. Now we're turning back down with the 5-day, and we continue to go down with the 10-day. That's more positive for the market. And we're just a little bit below the band here, even though we ticked up with the volatility risk premium, but not really giving us any extreme reading now. We're still looking good here with the advanced decline line based on price. We're a little bit behind here based on volume, but both are still looking positive. We did see new highs generated, and we're going up with our 5-day and 10-day. So this internal measure is still looking pretty good. We're still getting an extreme reading here with accumulation distribution, but we're positive. We were getting a little bit concerned about this, but we're continuing to go up. So this is now positive, but possibly a little bit far away from the moving average. We're still positive with the advanced decline ratio. And here's another breakout of the advanced decline ratio based on price and volume. Both are positive. And we're seeing an improvement here with another smart money indicator, the Chaikin money flow. We're flattening to slightly going up with the red line. Saw a little bit of an improvement with the histogram here that's in green. We're starting to go back up with the Chaikin oscillator. So the concerns that we were seeing with our smart money indicators now appear to be turning back more positive. And this was also another concern. We were pretty much flat, even though the green line's above the red line with the vortex. Now it's really starting to show some improvement. And we're looking pretty good here with the S&P 500 cumulative advanced decline line based on price. Tick down just a little bit more based on volume, but nothing too drastic, at least yet. And this is longer term, a 10-day average of the highs and lows for the S&P. We're getting back up into this extreme area, which could suggest good solid momentum. Not really seeing any disconnect between the S&P 500 itself and the NYSE advanced decline line. Came down actually, we went back up just a little bit with the cumulative NYSE advanced decline line based on price. We ticked down just a little bit here based on volume, but still looking pretty solid. I'm sorry, not based on volume. This is the regular NYSE advanced decline line. Looking pretty good with this other advanced decline line for the NYSE. We break it out here based on common stock price. We were up just a little bit and up just a little bit as well based on volume. Looking at the new highs, new lows, the daily score is positive and the red line is going up, showing more intermediate term strength in the broad market. This is another look at that same chart, just showing how the red line's going up. This is also the 50-period moving average. Not really seeing a change here, but for the most part, we're going back up here with the risk on to risk off ratio. When we're going up, folks are more risk on. When we're going down, that's more risk off. So if you're more positive on the market, you want this ratio to go up. Still looking good here with the advanced decline line studies with the NYSE common stock. The S&P's breaking out, turning up slightly, but not breaking out above this previous high with the mid caps, and we actually declined with the small caps. And we look at a 5-period moving average across the broad market of the highs and the lows, still getting a pretty solid reading there. Stocks above their 20-period moving averages in the S&P, going up and above 50. That's positive. We're looking at our study, we're above 70, which could suggest good short-term momentum to the upside. Going up with the 50-period moving average study, going back up with the 100 and also the 200. Looking at the ratio between large caps and small caps, we went up a little bit as large caps had a better day than small caps. And we're not really seeing anything here that I have plotted. We do have some overhead resistance, but that's well above where we're at right now. That would be up into the 5,800 level. We're above the 50-day moving average. We're above this pivot point. Volume really dropped below the moving average here. And we're getting just barely extreme with our 20 and 50, even though it came down slightly, period moving averages. And we're looking extreme still with the 200-period moving average. And this is calculated just on the S&P, not the stocks inside of the S&P. The condition of the 20-period moving average still looking good. We're above both lines and going up. The simple and exponential moving averages also looking positive, and now the blue line starting to cross above the red line. That's suggesting more good momentum. And we're looking a little extreme as we measure the distance away from the 20-period moving average. Here, we're not extreme with the distance away from the 50 and looking a little bit more positive when we measure the distance from the 200. And looking extreme positive or good momentum with the Stochh RSI, Williams percent R, the CCI 14, and the CCI 20. The stochastics looking extreme in the short, intermediate, and long term right now, and that's a further subdivision of the short-term time frame. The force index is above 0, positive, green. That's looking good there. We're still in the +2 channel with our standard deviations chart. And we're going back up and above 0 with the balance of power. We're still extreme with the CMB composite. The condition of the 50-period moving average, We're above both lines, and the red line is trying to cross above the blue line. That could be positive. Still looking positive with the go, no-go charts. We're coming up to the highest high value here. That's also positive. We're finally seeing a little bit of movement here with the TTM squeeze, and it's looking more positive. It's the lighter shade of blue. Standard deviation coming down, but still above the moving average. It's picking up this big upthrust that we saw here with the movement. If we chop sideways or don't see much movement, then the standard deviation will start to come back down. It's not measuring direction, just speed. We're above zero and going up with the ease of movement. We're above zero and turning back up with the S&P McClellan oscillator. So we're still going up with the summation index based on price and volume. We declined a little bit, but we're still above zero with the NYSE McClellan oscillator. Since we're above zero, we're going up with the summation index on the NYSE based on price and volume. And the Erin, it had been extreme, but then it just dropped off. And that's after we had that big Thursday move last week. And we're still positive here, but it's just kind of acting strange right now. That's why I kept it on the list. Now, this is still a little bit of a concern. The Swenlin trading oscillator. We're positive based on price and volume since we're above zero, but we are declining both based on price and volume. On a momentum basis, we're looking good with the PMO. We're looking good, but rolling over a little bit based on price. We're still going up based on volume. So we saw a bit of an advance with the PMOs that are rising. We're flat with the buy signals and still looking flat to almost extreme with the PMOs that are above zero. We're still positive with the Elders Impulse system for the S&P, positive with the parabolic SAR, positive with the slope oscillator, positive with the MACD, positive across the board in the short, intermediate, and long term with our oscillators that measure momentum. The Copic curve is positive. And we're coming down, but still extreme positive with the Sean trend meter. We're above all the plotted moving averages, and we're still extreme, but could also suggest good momentum with the bullish percent index. But we're getting to a point where this gives us a bit of a concern, but we're really not seeing any change to the negative side, at least yet. We're still going up with the NYSE bullish percent index. We turned down after being just barely extreme with the NASDAQ 100 bullish percent index. We're going to be watching the NASDAQ 100 and growth in Tuesday's session. We're going back up and above 50 with the money flow. We're declining, but above 50 with the ultimate oscillator. Still above an advancing moving average with on-balance volume. Still above 50 with the RSI 14 and just under being extreme with the RSI 9. This is the concern that I've been pointing out here, where the blue line and the red line are on top of each other now. If things were really going up more, we would see the blue line above the red line, but we're not really seeing that. The green line continues to go up. And still looking good with our weekly chart here. The S&P, we're well above this R2 pivot point level. So we look at the different trend measurements using different kinds of charts. We're positive with the Heiken Ashi, positive with the Kegi chart, positive with the Renko chart, positive with the three-line break. And here's the 150 above this red line, and the 200 is also above the red line, which also could suggest good long-term momentum. We're positive across the board with the Keller market model on all different time frames. We're positive in the short term with commodities, but negative in the intermediate and long term. We're still negative on all time frames with the dollar. And we had most of these sectors being up: tech, financials, and healthcare. Healthcare, that is a defensive area, ended up being down. Tech just didn't really have a very good day. Where energy and discretionary, we like this if we're more positive on the market. We want discretionary to continue to show some improvement. And all of the alerts that were triggered were positive, with the Dow setting a new all-time high. They don't have the S&P on here, but Canada setting a new all-time high. The NASDAQ got above 18,000, and discretionary, it sets a 2-year high. So we like that. That's more of a growth area. That can help the market to go higher. Not really seeing a disconnect here between the equal weight and the weighted version of the S&P. Saw a little bit of a decline with the ratio as the big stocks didn't do quite as well as the equal weight. Setting an all-time high here with the Dow, that's positive. We're still positive with the Elders Impulse system for the diamonds. And we were up barely, but the takeaway that I'm getting from this is that the NASDAQ is above its 50-day moving average. Also, we were up about 1/3% here with the NASDAQ 100, also above its moving average. And I have another moving average on here based on 20 periods. It's starting to cross back above the 50. That could be shorter term positive for the NASDAQ 100. The Qs are still positive with the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive. And we came, after coming down a little bit, we were up just slightly with the small caps here, but above the 50-day moving average. The other small caps, the Russell 2000, were declining, but still above 50 with the RSI, still above the 50-day moving average, and the momentum continues to be positive. And we are neutral now with the Elder's Impulse system when looking at the small caps. Mid caps, they were up 0.5%, but not really breaking out of this range, at least yet. Still positive with the Elder's Impulse system for the mid caps. Coming back and just almost setting a new all-time high here with the Wilshire. That's a broad market measure. Also up 0.25% with the total U.S. stock ETF. That's positive. And we're still coming down with our staples to tech ratio. If we're more positive, we want this ratio to go down. If this is going up, that means staples, a defensive area, are outperforming tech. And down just a little bit, but still looking solid with the financial sector. The FANG index was down almost 0.25%, still above its 50-day moving average. We're still having a hard time getting above the shorter-term trend line. That would be quite positive, although we're still well above this longer-term trend line. Apple was down 0.75%, still above its 50-day moving average. We were up over 1% with Amazon. We're a little bit concerned about this blue moving average coming down, but if we can stay above that, that could turn the moving average back up. Microsoft also coming down with the blue line, but still above its 50-day moving average. Google coming up to its 50-day moving average, down 1% here. So you see a lot of these big tech companies in danger of generating death crosses. And that's a bit of a concern, but it hasn't happened yet. And it can still take a little bit of time to play out. Where Meta was up over 0.5% and looking pretty solid. NVIDIA up about 0.25%, still on its 50-day moving average. Tesla was up almost 5%. That's where the discretionary strength came from and coming above its 50-day moving average. Netflix was up 0.62%, still looking pretty solid. Amazon and Netflix have pretty good looking charts right now. You're seeing a little bit of an improvement here when we look at U.S. stocks to world stocks on a correlation basis, just barely going up with the longer term correlation. Oil is still right around that 70 level. We're watching that more for geopolitical reasons. The dollar is still in a downtrend, even though it was up on Monday. And we just ticked up just a little bit with the 10-year yield. We were down a little bit with the 10-year based on price. We're watching this because we're seeing a real drop off in the 3-month yield. And that's kind of what we saw back in 2007. Now, we don't know if that's what it's going to lead to. The context right now is that interest rates are coming down. The yield curves, especially the 10 to the 2, are going back to being normal. We're wondering if the 3-month yield is going to be able to go back and be uninverted now. But we just want to keep an eye on this, since this is what happened before we saw some real problems. But we don't know those problems are going to develop yet. Seeing a little bit of an improvement here with the Qs to S&P. Discretionary is actually looking pretty good now compared to the S&P. A little bit above the moving average when we look at large cap growth to large cap value. So the large caps, mid caps, not really an improvement with the small caps. We want this ratio to go up. It's still going down when we look at the utilities or the S&P to utilities ratio. And we're going back up just a little bit with the staples to S&P ratio. We want this to go down. It has been coming down, but it did tick up on Monday. And then here's the definition of a Hindenburg-Ullman. We don't have another spike up yet, but this is now confirmed. And we're just going to see if that ends up leading to anything like it did right before the COVID crash and right going into the end of 2021. So what's our outlook then for Tuesday? We're still positive. And I'm not as concerned about the smart money indicators right now if we see more follow through. But we do have this confirmed Hindenburg-Ullman and weak seasonality in the background. It may not turn into anything. It may take a little while to develop. And this is the week after options expiration, and that tends to be a pretty negative week overall. We're going to get the FHFA Housing Price Index and the Case-Shiller Home Price Index. So we're getting some housing and real estate information coming out this week, and consumer confidence. That can be kind of a big one. And then the different geopolitical things going on to see if any of that has an impact on the market. And so then Wednesday night, we'll get new home sales. Probably the big day will be Thursday with weekly jobless claims and durable goods. The only reason I have GDP, the third estimate, in gold here is if it's way different than the two other readings we've already had. But the big inflation day is going to be on Friday with the PCE prices coming out. So here is consumer confidence for Tuesday. Seasonality. We're negative with the Dow and S&P, where we're neutral to negative with the NASDAQ for September 24th. And we're in this week after options expiration, where we're only up 30% of the time, but we're still up 30% of the time. Okay. So we can't just say, oh, everything's just going to go in the toilet. Yeah, the odds are, the percentages are that we're going to go down, but we have to actually go down for that to happen. Okay, so looking at some negative seasonality here, according to the Stock Traders Almanac. Tuesday, it's kind of a flip of the coin for how things acted in 2023. Tuesday was positive so far in 2024, and we're coming into that weak seasonal time, according to the Carson chart. Also, some weak seasonality here when we break it out a little bit and compare it to 2023. So what are the warning signs? Again, the Hindenburg-Ullman, it's there. And you're going to hear me saying this for quite a while. When we do have weak seasonality, until we get through that, we're keeping an eye on these defensive sectors like staples, utilities, and healthcare. We're mainly watching energy from a geopolitical standpoint. And then growth to value and discretionary to staples. We want to see more. Discretionary to staples is probably looking okay now, but we want to see even more going forward if we can remain positive. And the positive signs. I've taken the concerns off of our 3 smart money indicators, but that could come back very easily with a down day on Tuesday. We're still going down with the 5 and 10-day equity put call ratio charts. That's positive. The advanced decline line still looking good. Our oscillators and Copic curve are looking good. We're still positive with the S&P and NYSE McClellan oscillators and summation indexes. The Swenlin trading oscillator, this is probably one of the bigger concerns right now because it's going down as the S&P is holding up a little bit better. The parabolic SAR, though, is still positive, and we're still extreme with the bullish percent index for the S&P, but the NASDAQ 100, it came down from being extreme, and we're still positive with the NYSE bullish percent index. The vortex is positive, the money flow, the ease of movement, and the ultimate oscillator are positive. The momentum for the NASDAQ 100 is positive, and the financial sector is positive. So our conclusion, we're positive, but we have this confirmed Hindenburg-Ullman and weak seasonality. We're still going to kind of watch the smart money indicators, even though they're looking better than they were. In the short term, that's what we're going to be watching, are the smart money indicators, but we're still positive in the short term, still positive in the intermediate term, but we're wondering if this Hindenburg-Ullman and weak seasonality will turn into anything. And in the long term, we're also positive, but we're looking a little extreme. That's why the OB for overbought is on the list here. Thank you. I hope you have a really good day, and I will talk to you in the next video.